Okay, so Jeff Bangerter here again, Bangerter Financial Services. This year has been quite a different story from 2019. In 2019, we had really a great year. U.S. equities were up 31.5%, international up 22, emerging market was up almost 20. I mean, it was a good year, no question about it. But really, equity markets took their fastest tumble in history from a record high. In 18 trading days, the U.S. equity markets fell more than 30%. For the full quarter, U.S. equity markets returned minus 19.6%, making it the worst start to the year in history. I mean, so this is really a big issue, and certainly I know you're concerned about it. Many of our clients are concerned, and certainly, we're trying to help, kind of sell in the right direction and get things rolling into a positive area. So international markets did fall along with U.S. markets, with developed markets returning minus 22.7. Again, this is all through March 31st, which actually was the worst day. And the emerging markets returning minus 23.6. Only two countries, New Zealand and Denmark, fell by less than 10%. Over the quarter, and China fell by 10.2%, which was the main reason that emerging markets outperformed developed markets in local currency terms. Now, once again, strengthening dollar weakened returns for U.S. investors. That happens periodically, we know, and it's certainly something you have to be aware of. And this fall in equity markets created really carnage in the bond market as well, as liquidity dried up in the bond markets, with investors selling anything they could. The Federal Reserve stepped in to help limit any further carnage to the bond market, lowering rates to pretty much zero with all the quantitative easing. So it was certainly a rough quarter to be in. And so as we look at the different segments of the market, right, technology actually held up the best. So it was down minus 11.9%. This was really helped by Microsoft, which was actually positive by 1 basis point for the quarter. Consumer staples and utilities, the bond proxy sectors really outperformed the broad markets, while energy was just crushed down 50% and continuing. All of you are aware, oil it was negative again this morning. I mean, it's just all over the place right now. So it definitely has been a wild ride for some of these assets. And so I want to talk a little bit about the flight to safety to the bond markets and go through this a little bit to help folks understand. Bonds in and of themselves are not the solution. And so the U.S. bond market did end up for the quarter 3.1%. Aided by the strength in treasuries, which actually did really well. The flight to safety saw treasuries rally, with the longer duration treasuries seeing a return of 20.9%, which is great, but you normally wouldn't have all your money in long-term treasuries. And so with treasuries making up almost half of the index for this Bloomberg Barclays U.S. aggregate exposure, right, that helped. And again, there was no high yield in there. Bank loans and non-agency mortgage-backed securities, MBS, you'll see those in there. It's no surprise that the Barclays aggregate saw a positive return. So that was great. And again, we typically have blended portfolios, so this would be part of what would be in a portfolio. The sensitivity of high yield bonds to the equity market saw them register double-digit losses at minus 12.7. Bank loans also saw double-digit losses at 12% as the Fed lowered interest rates to zero. And then within the securitized sector, the agency-backed securities and agency-backed mortgage-backed securities regained ground following the market rout and saw a small positive return for the quarter. However, with the support of the Federal Reserve, and even these non-agency mortgage-backed securities did see returns of minus 13.4. You can see that down on the bottom. We have used some other tools. We have some real estate debt securities. They were also brought down significantly during this time. I think the big concern in the real estate debt offering is people are concerned as to whether or not people are going to pay their mortgage payments. You know, they're trying to get forbearance on everything, so that certainly has had an impact. By considering the returns of the market, we can help to explain portfolio returns so that you can kind of understand if you saw, you know, a 15% decline in your portfolio, actually still not as bad as the overall market. There was really little place to hide this quarter as asset classes were hit from all directions. I mean, everything was pretty well hammered, as you can see. On a relative basis, managed futures strategies, which we use, benefited from being long bonds, especially long duration and the US dollar. Slightly short on equities and short energy, so those were good. Tactical strategies help limit the downside by moving out of equity exposure. So again, we don't just buy into passive strategies. We like active managers. We like to have a blend of what we'll call core. We'll talk about that a little bit more with these other pieces to limit the downside loss when they occur. So within equities, it was only U.S. equities that had better relative performance than global equities. So tilts toward U.S. large caps would have better relative returns. Again, when you're negative, it still doesn't feel good. Dividends, which you would expect to hold up better in a falling market, struggled due to concerns that parts of the dividend universe were at risk, right? That they're going to be cutting their dividends. So especially with energy being a large component of that universe. So it's no surprise that small caps fell the hardest due to their lower levels of profitability and higher level of large cap names in there. So portfolios with exposure to dividend payers, which we have federated, if you are familiar, we've had federated out here. They actually felt a little bit more pain than you would have if you were in, again, a more actively managed, diversified portfolio. So just some key things, key takeaways, I think. This has been the fastest and quickest fall in history. You know, again, 18 days, very quick. Volatility significantly increased. I'm going to show you some numbers that will blow you away. It does have the anatomy of a bear market. I'll talk a little bit more about that. The market has always returned to its prior high. That's the part that people struggle with, right? I've had, you know, I've mentioned this a couple of times. So in all the downturns that we've had, so the, you know, 2000, 01, 02, and then, you know, late 07 till early 09. In both of those, I had one client we call it capitulate, where they just said, I don't care how much I lose, I'm just out. This year, I'm going to call it 1.5. I had one client that totally exited on the worst day you could possibly get out. And they've missed the rally, probably would have got back, you know, half of what was lost. But, you know, again, people do things for, you know, they get emotional, and I understand that, but that's our job, is to try to keep you on an even kill. But, you know, if you tell me you want to go to cash, I can't stop you from doing it. And then I had another client that exited some of the assets. So I'm calling it 1.5 clients that got out on the worst possible day. Hang in there is the best strategy, honestly. Anyway, we are gaining insights from China because they were kind of at the beginning of this whole thing. So we'll talk more about that too. And then when we think about the portfolio, the strategic portfolios naturally de-risked. And so that's why we like them. If you just buy the S&P 500, you're taking all of the down with all of the up. I mean, you're getting bounced around pretty hard. And then tactical strategies actively de-risk. So they are in there making decisions. When they see things changing, they're dealing with it on the fly. And I like that. I like to have a blend in here. And then even a diversified portfolio will automatically adjust, because as your equities go down, you end up with a larger fixed income or bond exposure, you know, so that's just part of the natural occurrence. So this is kind of an interesting graphic, and it is kind of busy, but let me go through it a little bit with you. So again, this was the fastest drop in just 18 days. We saw the market drop, and you can see the blue dot there, the 2020 dot, right? So that's how far down the market went. So when you look at this chart, right, this x-axis is the this is the y-axis, this is the loss, and this is the time over here. So how many days, right, and how far down did it go? And the red dots show bear markets that coincided with recessions, while green dots show bear markets that are independent of recessions. And one key takeaway from the chart is that bear markets with recessions are generally worse than independent of recessions. And you can kind of see that, as you think about here's '02, right? So it took a while. It, took quite a while for the market to get down that bad. You can see, again, '01 was part of, is really '01, '02 all blended in there. And you can see all these other, 1917, there's all kinds of different places, but you can see '09, see how long that took. That was 350 days before we got out to the bottom. Now that was a really far down bottom, but that was an actual recession, So if you look at, these markets where it goes down and it's kind of independent of, the economy slowing in general. So these are down because of some event. It's an event-driven drop in the market. That's what this has been. And if you think back to, the 1987, actually, it's right there too. So that was one day, but that was kind of, again, this flash crash type of thing. And then it recovered quickly. And that's really what I want you to think about this is how long does it take to recover from one of these, either a recession, an actual recession, bear market, or just this kind of independent issue that happens. And so as we take a look and, see the recovery, it's followed, there's a lot of volatility that's in here, and you can see the volatility on this bottom line, the volatility, the VIX down here. You can see how it spiked up. I mean, that was just a crazy level of volatility, around 50. Is kind of the normal when things get crazy, and this got up to 80. So it was really beyond any VIX level that's been, in history. But it's back down to about normal. It's about at 50 again right now. And so things are calming down, and, yes, the market is starting to rebound. You can't really see that upswing there, but we have recovered some of the loss. And so that's starting to occur, which is obviously a good thing. And then as we look at this, it helps you understand these types of bear markets, right? So given that we are in a bear market, it's kind of how do we get here, right? So there are three main characteristics of a bear market, or different types of bear markets. The structural bear markets occur when there is a structural imbalance and financial bubbles. The best example is the global financial crisis, again, late '07 through early '09, a result of leveraging, housing market bubble, and the collapse of Lehman Brothers. A structural bear market tends to be the worst in terms of the returns and the length. On average, structural bear market has seen a loss of about 57% over 42 months. So they are, again, a little more painful, take longer to go through them. And then cyclical bear markets occur as a result of rising interest rates, impending recessions, and falls in profits. And they are typically a function of the economic cycle, the normal business cycle that we go through. And the most recent example was the Volcker tightening in 1980 through '82 as a result of the high inflation caused by them raising interest rates to 20%, which was crazy. That was 79 was when I was in the mortgage business. And yeah, it was totally nuts back then. But on average, a cyclical bear market has seen a loss of just over 30%, and it takes 27 months. It goes for about 27 months, and then the recovery takes about a total of 50 months. And so, again, it's lengthy, but not as bad as a structural bear market. And then the event-driven bear markets offer kind of this one-time shock that happens, and it could be war, it could be oil price shocks, technical market dislocations. The last event-driven was that Black Monday, 1987, and when it was program trading that created this sudden shock to the system. It was dramatic. On average, event-driven bear markets see a loss of about 30%, but they tend to be the shortest, with the loss occurring over a short time, like about 9 months, and recovering over about 15 months. And so that is kind of what we think we're in right now, is this event-driven market. Now, it could push it into this cyclical market too. So, it depends on how quick they can, get everybody back to work and get things rolling along again as to, what's going to happen. And so the part that is hard for people to, kind of, I think, come to grips with is that they have always recovered in the past. So we assume they're going to recover this time too, right? And so if you go back through the market history, we know that these major drops, it just takes time and then you get back to where you were. So as we sit at the end of the quarter, we were down 24% from the market peak, which includes about a 15% rise from the market bottom. So let's think about what we need to get back to the market peak of February 19th. So the S&P was at 3386 at that point. So the chart on the left shows the annualized and cumulative total return needed to reach that peak over different time periods. So if you get there in the next year, we'd have to get a 33% return on the S&P 500. Could happen. I'm not betting on that, but possible. If it happens over 5 years, that's an annualized return of 8%, which is a cumulative return of 44%. Hopefully that makes sense to everybody. And if it goes out over 8 years or more, it's an annualized return of 5%. Well, if you think about it, if we're getting 5% annual returns or better, that's still pretty good returns on your money, right? So I want you to just kind of bear that in mind as we look going forward, that still would be a reasonable return, okay? So I'm going to move on. I think there's a question out there. I've got a couple of more slides and then I'll go off to all the Q&A. So you guys, any questions, load them in there, and if I need to go back to a slide or something, we'll do that too. So anyway, what we've seen is that the market not only returns to its former market high, but it goes on even higher. And using the last bear market as an example, right? So if we go back to that 07 through early 09, if you would have been as unfortunate as you could be and bought in at the market high, so on October 9th of 07, that was the peak, and then you rode it through the end of March, you still would have made 117.1% total cumulative return. Now, if you'd have timed it just perfectly and bought in on 3/9 of 09, which was the bottom, and held it through the end of March, right? Then you would have had a 376.4% total cumulative return. You had been really, really lucky to be able to do that. But either way, you made a really good return. So even if you bought right before the market tanked and held on, you're fine. And again, if you actually deployed cash when the market was down, which is really hard for people to do, right? I mean, it is a struggle. I understand it. And I've been pretty upfront about, I have added money in over the past month or so in different positions. So I am a believer, right? I think it makes sense to do that. And so anyway, we want to gain some insight from the experience in China. As we know, they were kind of ahead of the curve. That's putting it pleasantly, right? I mean, they should have been warning everybody about what was going on and didn't. But anyway, now that we know COVID-19 is having this significant impact on the economy and markets, with all this shelter in place, let's take a look at what's happened to China. And so firstly, the purple line that's, kind of all over the place there, starting at 100 on 12/31. Anything above 100 on the left-hand scale means China was outperforming. Anything under 100 means China was underperforming. And what's clear to see is the relative performance of China fell off as the cases came in. As they were, they had more cases, they slowed down, and as there were less cases, they started to grow again. So if we take what we see here and we apply it to the US, we should have the same outcome. We should have, as we have less cases and people are allowed to go back to work, the economy should improve, right? And that's really what we're looking for. And so when you look at your portfolio, again, we don't buy one asset. We have a lot of different things usually in our portfolios. And so they have this natural de-risking nature to them. So I'm going to just use a 60-40 portfolio. Not all of our portfolios happen to be there, but again, we do have a mix of things in the portfolios. So assuming there was no rebalancing of the portfolio, someone who started the year at a 60% US equity and 40% bonds would now hold 54% in equity and 46% in bonds at the end of the quarter. And so that's why I say this is kind of a naturally occurring thing. That's why we blend portfolios together. Certainly we can it depends on your risk tolerance, right? And so I've had some clients that just said, no, go all growth. I want to beat the S&P 500. And, they are licking their wounds a little bit for that choice, but that's what they wanted to do. We do have programs, managers that do consistently outpace the S&P 500, but they get beat up on the way down too. The tactical strategies, the ones that will move in and out of these assets, we saw these tactical managers actively de-risk the portfolios. And just to give you an idea, we have Aster that we use quite a bit, and they have made dramatic changes to the portfolio. But that's why we have them in the portfolio. We want that to occur, right? So the tactical limit loss managers reacted to the increased market volatility and significantly decreased the exposure over the period from being close to 80% in equities down to like 20%. So they have reduced the risk. That's what we wanted them to do. And the more tactical strategies with bond diversifier categories took action during the quarter. So their risk asset exposure was kind of changing. They had already de-risked, and we do have some portfolios that are positive for the year, so it just depends on, what your risk tolerance was and how much total return we were trying to get out of the portfolio. And I think everybody does have kind of a different perspective now, right? When the market is going up and up and up, everybody wants to take on all the risk. And when the market goes down, like it's been, now is actually the time to, think about, okay, should I take some of my cash and put it in and buy low, right? Buy low, sell high. That's the strategy. Anyway, our investing evolved philosophy believes in diversifying across different strategies. So if we put it together in a portfolio, which is how we do this, right? We don't buy just one thing. It's not like just one bucket of money all treated the same way. We have these different strategies and it gives you different risk exposure. And so with the majority of the portfolio in a core market, so core markets are, again, kind of the S&P 500. We use Dana. Some of you have come to the events that we've had with Dana. That's a core market. We have JP Morgan. We have State Street Global Advisors. They are core market providers. So we do have quite a few that do the core strategies. But then when we mix them in with some of these other assets, again, I mentioned Asset Mark, and we have double line with the Case-Shiller Index. We have these other strategies that we can blend in with there. Then we try to mitigate the downside while still giving you as much of the upside as possible, without being just total S&P 500 and hope it all works out, right? I just don't think most people can handle that much downward pressure. So anyway, so just to kind of finish it off, and then I'll go into the Q&A. When you think about the core markets, again, it provides you this equity exposure across the entire global markets. And we use strategists that have different ideas about that. Some are just all U.S. Dana, I mentioned, it's all U.S. Whereas State Street Global Advisors, just by their name, right? It's a global strategy, and they're going to have a lot of things around the world. And Aster, I've mentioned too. They actually will go anywhere for the return. So they don't care if it's U.S. equity, U.S. fixed income. They'll even go short the market if it's going to be a protracted bear market, right? So they're looking at all of those things. And then those tactical strategies, that's where we want them to do that. That's, again, I mentioned double line, the Case-Shiller index. We want that. So each part of this builds the portfolio. And everybody is different that we work with, right? You might just say, hey, no, I am just really conservative and I am okay. If we just make 5% a year, and that's perfectly fine with me. I don't need to have all the ups and downs of the stock market. Then we have strategies for that. And it's kind of funny. I've actually mentioned a couple. I won't get into a specific asset, to drive a point, but I've had clients, I've told them we have some things that pay 5.25% consistently year after year after year, but they're really boring because that's all they do is pay the 5.25%. But, right now, those of you that have some of that are probably thankful that we have some really boring stuff that's just paying 5.25%. And so, all of those things are available to have in the portfolio. And it's really the way we approach this is we call it, we co-create the portfolio, because sometimes we'll recommend an asset class that for some reason you don't like it, you don't want it. We've had, I know we have a pretty good group of folks on here. We've had conversations about all kinds of products here in the office, whether it be a fixed indexed annuity, whether it's a real estate based asset, all kinds of things. And some people have a preconceived idea about it, and they just don't want to do something. And we won't make you invest in something that you don't feel good about. All of those that have, and I'm, kind of looking through the list of folks, there's quite a few that have like the fixed indexed annuities in the portfolio. Aren't you glad now? I mean, the performance was not great for the, it wouldn't compare to the S&P 500. It was never up 19 or 20%, or, we had Dana was up 35% last year. Yeah, your fixed indexed annuity wasn't, but you know what? Your fixed indexed annuity hasn't lost a penny, right? And so it's nice to have. And so we just believe in really diversifying the portfolio. One of the things that we have talked about, and I'm going to have them back on, is we have some strategies where we can actually limit the loss in the portfolio, and it's kind of your choice. It's like hey, I want a 10% buffer, so the first 10%, I don't want to fill it, right? In other words, the company is taking that risk for you. And then you can go further and you can say, well, I don't want to fill a 20% loss. If the market goes down between 1 and 20%, I don't even want to worry about it. And your account would reflect no loss. We have that. And I even have as far down as a 30% protection. So that if the market goes down 30% and it happens to be your anniversary on that day that it's down 30%, you would still not lose a penny. And we've had educational classes on that here in the office. And I think while the market was going up, nobody was that excited about that. It's like, who cares? The market's returning all these great returns. Again, I think diversifying not only in strategy and asset class, but asset type makes the difference, right? So if you have, even in the real estate side where we do a lot, right? If you have the apartments, well, they are concerned about people not paying their rent right now, as you can imagine, right? Well, if you've added the industrial offering that we have, they're booming, right? Everybody is buying everything online, or else, trying not to go to the store as much as possible. So those guys are really doing great. And, so I think it's being flexible enough and putting enough different kind of assets in your portfolio. And if you really think about it, if you think about Yale and Harvard and Stanford and how they manage their money, these guys have multi-billion-dollar portfolios. That's what they do, is they diversify among all kinds of asset classes, all types of assets, direct ownership, private placements, everything. And that's what we do. We just believe that. I don't think everything should be in the stock market. And it's kind of interesting. I had a conversation, one of my longtime clients, we talked about doing, like I say, the fixed indexed annuity probably a couple of years ago. And her friend talked her out of it. And it's like, okay, well, that's okay. If you don't want to do something, we're not going to make you. But again, that would have zero loss right now. And I don't know what her friend knows. I have every license you can get in the financial industry. I'm not sure how qualified her friend is to be giving her financial advice. Anyway, sorry, I digress. Anyway, let me go ahead and I'm going to get rid of the presentation and just open it up. Any questions? I've got one up already. Let's see. Does event-driven suggest we are now at the bottom, and has this only been a few weeks? So the event-driven is, it's not that we're at the bottom, it's the event, right? So obviously the coronavirus is the event. It's driving the direction, and we definitely have been lower than where we're at now. Nobody really knows if we're at the bottom. I think what's happening is that we're getting pushed into now a cyclical bear market. So depending on how quick we can get people back to work, I mean, if they turn everybody back out, go to work, go get out there, go to work, go buy stuff, next week, then maybe it's a V-shaped quick recovery and everybody's happy again, and all the financial experts that I'm on probably minimum 3 webinars a day with these big financial firms, JP Morgan and State Street and Federated and on. Just every name that you can imagine we're listening and getting information from. And so I would say most are saying, a nice recovery starting June and running through the election. But does that mean you're going to be even by the election? I don't think so. I think it's going to take longer than that to get back to the high. And I don't know. I don't have a crystal ball. But that's the sense I get. If it goes on longer, if I know it gets kind of funny because it gets political, which is crazy to think. When we get into these situations, there is definitely people saying, no, keep everything closed longer and longer. And for a year or two, it's like, we will destroy our country if we do that. And I think people are starting to get the reality check that yes, the coronavirus is dangerous, but the death rate is actually, a month ago I said, it's not that bad. My wife is a nurse. The hospital is empty. There are no coronavirus cases in Roseville, 0. And there are no other patients in there. I mean, in her last 2-week period, she was supposed to work 9 days, she worked 2. So it's not the big thing that everybody is making it out to be. Thank goodness, right? I mean, that's good. Anyway, another question. Are any of the investment offerings holding back on guaranteed returns? And are those mainly annuities? So the guaranteed products are always annuities, right? We can do CDs too. You can get 0.6 or something in a CD. The annuities would have been better to have been purchased before this, because the rates on the annuities are pretty far down there now too for new people buying in. Just like anything, right? If you can't wait till the house is on fire to buy fire insurance, right? And annuities are the same thing. If you waited until now, you're not going to get as good a deal as you would have got when things were great. And that's exactly what's going on. The people that had them have really good renewal rates. I've multiple times talked about people who have gotten double-digit returns on their indexed annuities. And right now, the cap rates are really low, 3%-ish. We'd have to have a conversation. And again, I hope everybody knows, not everybody's a client that's on the call, but we're a broker. We are not married to any company. We look for the best offering in every asset category that will get our clients the best return. And so we'll look at all of the different choices and see who's got the best upside potential and provide the downside protection. So that's coming in on the chat box. There is the Q&A down there as well. So we're out about almost 40 minutes. Let me just kind of tell you what we have coming up, and so that you can look, forward to some other things. So we do have, I have been talking to State Street Global Advisors. I believe we'll have them on a call over the next week or two. I've been talking to JP Morgan. I think we'll have them on a call in the next week or two. We've been talking to Lincoln Financial, which does have a product that guarantees, again, that downside risk, and you get the upside. So we'll talk more about that. I think that's a great strategy for now. The indexed annuities, those rates are just so low, it's pretty hard to get excited about. It is a guarantee. You can't lose money, but again, it would have been so much better had we bought in a year ago. Even a couple of months ago, right? Before all of this. Anyway, so, but these other products, these limit loss products, so they're not, they don't guarantee your principal. If there's a downside, right, you take on some risk. So if it's a 10% buffer, they're taking care of the first 10%. But if the market was down 30% on your renewal, right, on that day, then you would lose 20. They would cover the first 10 and you would eat the next 20. If you had a 20% buffer, and let's stay with the market being down 30%, then you would only lose 10 because they're going to eat the 20. And if you have a 30% buffer, you would have no loss. So I'll have them on as well. I think it's already scheduled. Again, my staff kind of handles all of the calendar events. So, but I know that is one that we have coming on. The real estate side, we've had, this is for accredited investors, this part, but if you're an accredited investor, we've talked about the industrial warehouse kind of offering with, I'll just talk about industrial and just say that. So it's paying a 5.3. Well, guess what's been happening lately? Industrial is booming, industrial warehouse, because everybody's buying everything online. And it's really interesting. I met with one of my clients. He's in his late 70s. We're doing, he's doing some 1031 stuff and some other things that we're doing with him too. And he said, I've never really bought anything online until now. And now that I've bought stuff online, I'm thinking, why would I go back and go hassle with a store? And honestly, I think that is the biggest thing that this coronavirus stuff is doing, is that all of us, many of us were buying stuff online anyway, but now we're doing it even more so, and we're getting comfortable with it. And so it's like, well, why would I go back and start, got to go hike over to the store and deal with the crowd and all that. And I think even as the turn back on the economy, right, and we can go shopping, I think there's still some apprehension. People, do you really want to go be in a really crowded big box store? Which is kind of funny because I see it still going on right now. You go by Walmart, it's packed. Sam's Club, Price Club, they're packed. I was driving by Green Acres, and they have their overflow parking. It's packed. So, people aren't, I think most of us are sort of over it. It's like, whatever, people die from stuff every day. Let's get back to work. Again, this is personal opinion. I don't know. So I don't see any other questions, but I do want you to, again, keep an eye out for these educational events. We really think that, now is the time where you can really look at, what risk tolerance are you really comfortable with? When everything's going gangbusters, everybody's aggressive. But when you get beat up like this, now's the time to take a look and say, you know what, I'm not that aggressive. And I want to have some things that are guaranteed, or I want to have some limit loss strategies in my portfolio. And we have a lot of that. That's why we're here, right? You can buy the S&P 500 yourself. So if you're willing to take that much risk, no reason to pay us, right? But if you want to have less downside and still have a good upside, that's why we're here. If you want to have some guaranteed products, that's why we're here. So diversifying the portfolio across a lot of different things is really our job. And we look at all of this stuff all day long. I know you guys are all aware of financial products. It's all I do every single day. We look at these things every day. So I'm not saying I'm great. I'm just saying we are more exposed to it than most people. So we can give you some advice that I think will pay off in the long run. So I don't see any other questions. So I'm going to say, have a great Friday. I'll give it, maybe 30 more seconds if you got one last thing you want to type in. Otherwise, give me a call. Be happy to chat with you. If you do want to take advantage of some of these, real estate offerings, the limit loss strategies, give us a call. And we are meeting with folks on a limited basis. So I should say that too. So we are, we wipe down the office before somebody comes. So if we know you're coming, right, we wipe it down first. And as soon as you leave, we wipe it down again. And at most, we've had 2 clients in one day. So we keep it really, we want to be respectful of all of our clients and our own health, right? We want to make sure that we all stay healthy. So, all right, with that, I will say thank you so much for attending, and watch for our next invites, and we'll educate you some more. Thanks so much.